All right, so this is the question that we have. Just as I promised last time that I would do a question together with you on manufacturing account, just to cement the understanding that you have. Last time we had time to look at the format of a manufacturing account, just the format of a manufacturing account that was looked at. But now as for today, it's important that we look at one of the practical examples on the manufacturing account. So let's see now, how do we follow that format? How do we put in numbers into that particular format? So we are told that Yasmin opened a garment factory on 1st May 2016, and so she provided the following information: that on 1st May 2016, the cost of factory machinery was given as $35,000, cost of office furniture and equipment 8,500, cost of tools. And for the year ended 3rd April 2017, we are given revenue, the purchases of raw materials, the purchases of the finished goods, the wages, the factory operatives and the factory supervisors, office and the sales staff. The general expenses are given as factory. They're divided into factory and office. And the rates are also divided into factory and office. Then you're told that at the end of the period in question in 2017 April, the inventory of raw materials were 3,150. Work in progress was given as 2,820, and you had the inventory of finished goods, and the value of the tools had been given as 830. Wages accrued, there were accrued wages on the factory operatives and of the office sales staff. There was also an additional information that, number one, no additional non-current assets were purchased during the period. So there was no purchasing of the non-current assets. The factory machinery is to be depreciated at 20% per annum on costs. So that is to say, the factory machinery was to be depreciated on a straight line method, right? The other name for the straight line method of depreciating non-current assets is also called the depreciation per annum on cost. So the office furniture and the equipment is to be depreciated at 15% per annum on cost as well, which is the same as straight line. And then the tools are to be revalued at the end of each financial year. What are you required of doing? You are required of preparing the manufacturing account for the year ended 3rd April 2017. So you are asked to prepare a manufacturing account, okay? Prepare the manufacturing account. So how do we prepare the manufacturing account? That's where the question starts from. So we say that the whole idea behind the manufacturing account is to assess the cost of what? The cost of production. We just want to assess the cost of production, okay? Of which that same cost of production is the one that we are going to send to, or to post to the income statement of the finished goods. So we can write the title as Yasmin's what? Manufacturing account. Manufacturing account for the year ended when? The year ended the 3rd April
2017.
Yes, thank you. 2017. This should be your title. Yeah, as usual. Then you have, as usual, the two columns. You have the two columns. of this statement, just like on the income statement. And the units are given in dollars for the currency that you're using. So it's actually the cost of materials used. We know that the cost of production, we are just following the same format that we gave you. So following the same format, since I'm not teaching the format now, let's have the cost of materials used. We start with the cost of materials used. You can write that M is material. So cost of materials used. To start with, you have to write down the opening stock. Okay, if you have any opening stock, check if you have the opening stock. The raw materials will start with the opening stock of raw materials. Do we have the opening stock of raw materials? Remember, this period started in 2016, May, and it is closing in April 2017. So do we have the opening inventory of raw materials?
I can't see any, what's this? Opening stock here, sir.
Okay, so we don't have opening stock. Yeah, so if you don't have opening stock, we go direct to the purchases of raw materials, right? To opening stock, you add purchases of raw materials. So let's check, do we have any purchases?
Come again on opening stock and purchases, you add them?
Yes, you add the opening stock, just like that same income statement. Yeah, so to understand this properly, first of all, before you listen to it when you're done recording, you have to listen to the format. Get the format first, the format that I gave in part 1 of this manufacturing account. Then it will be now very easy to just plug in numbers, you get?
Yeah,
so
yes, sir.
You have to add what? The purchases of raw materials. So since we have the purchases, we can write the purchases of raw materials. And what's the value of the purchases of raw materials?
It's 30,100.
30,100. So you can write 30,100. Oh, it's 30,000, not 3,000. So you write 30,100, right? Now to raw materials or to the purchases, you're going to add carriage inward of raw materials if you have any carriage inward. Do you have any carriage inward for raw materials?
No, we don't have.
You don't have the carriage inward for raw materials. Then if you don't have that, you can now less the purchases return, right? Which is also called the returns outward of the raw materials, of course. We are concentrating on the raw materials. Do we have the purchases return of the raw materials?
No.
There are no purchases return for the raw materials. That which simply means the next thing you will do is to less the closing inventory of raw materials. Yeah. So you less what? You less the closing inventory. The closing inventory of what? Of raw materials. So you can less the closing inventory. It shall not be labeled as the closing inventory. That's why you have to look at the periods that you're dealing with. Okay, this period started in May 2016 and it ended 30 April 2017. So do we have, as of 30 April 2017, do we have the stock of raw materials?
Yes, sir. The stock of raw materials.
Yes.
Yes, this one 3,150.
Yeah, that's the closing stock of raw materials. 3,150. So we can less that And what do we have? As the raw materials, the cost of raw materials?
28,050 kwacha. Let me just get a calculator. 28,000.
Get a calculator.
27,050 kwacha.
Are you using a calculator?
No, let me just punch on my calculator. Yeah, it's 26,950.
Okay. So 26,950. This is the cost of raw materials. To the cost of raw materials, then you can add what? The direct wages. Can add the direct. You can add direct wages or direct labor costs.
Okay.
How much are the direct wages? Let's check. Under wages. Wages and salaries. So when we say direct wages, we mean the wages that occurred in the factory, okay? The wage that, whose labor is used in the factory. If you're paying for someone who is working in the factory, okay, that wage is called a direct wage or direct salary. How much were the direct wages?
There are direct wages here.
Yes. You can see the wages and salaries, right? So
yes,
there are some wages that go for factory operatives, okay? These wages, they go direct in the factory, so they are direct wages. Yeah. So you get 31,500 direct wages. But again, you are given an additional information about wages. There are some accrued wages, isn't it? Down here.
Yes, sir.
Have you seen the accrued wages of factory operatives? 800. So which means I said accrued expenses have to be added. That's what we learned from the sole traders statement. So you have to add to that amount this 800. 31,500 plus 800. Okay, that forms the direct wages. 31,500 plus 800. And what do you get?
At what?
31,500 plus 800.
$32,300.
Okay, so 32,300. Right. So you can add these two. What do you get when you add the two? When you add the cost of raw materials by the direct wages.
It's 59,250.
Right. 59,000. 250. This is called the prime what? The prime cost. If we had the direct expenses in the question, we could have included before totaling up everything, okay? But we don't have the direct expenses. We just have the general expenses, okay? We don't have the direct expenses. So the prime cost is made up of all the direct costs. That's direct material costs, direct wages or direct labor costs, and direct expenses. So since we don't have direct expenses now, we can just add what we have which is the cost of raw materials plus the direct wages, which is direct labor cost, and add all together, that gives us what we call the prime costs of production. Is that clear? Hello? Hello?
Yes, sir. I can hear you.
Okay.
Yes, sir.
To the prime costs, let me erase now. We have ended on the prime costs. So you have the prime costs. How much was it?
The prime cost is 52,250.
It was 59,200.
Oh, sorry, 59. Sorry.
And 50. Then you have to add now the factory overheads, okay? To the prime cost, you have to add, that's what we said in our format, add the factory overheads. And what do we have under factory overheads? Okay, our factory overheads refers to all the indirect costs, okay? Those that do not occur in the factory, like the indirect costs that don't occur, the indirect costs that occur in the factory, sorry, those are indirect factory overheads. The factory overheads, they occur in the factory, but they are not direct, okay? They are indirect. For example, factory supervisors, right? The factory supervisors, the people who work in the factory to supervise other people, right? They are supervising other people who are handling the work direct in the what? In the factory, isn't it? So the supervisors, their wages are indirect wages. You get the point?
Yes, sir.
Yes, so you can write indirect factory wages. The indirect factory wages. And under indirect factory wages, what do we have? 11,860 in the second column. Then we go to this amount, we add what? What are we adding? Do we have any other factory overhead? Any other overhead? All the overheads. Let's check. The general expenses, isn't it?
Yes, sir.
The general expenses, these they occur in the factory. There is a fraction or the part that occurs in the factory of the general expenses. So you should write that. Not those that occur in the office. No, we're talking about the factory. So 3,240 general expenses. The general factory expenses. Is 3,240. What else do we add? The rates. You've seen the rates, right?
Where are they? Okay, yes, sir.
Even the rates are broken down. There are those that occur in the factory and those in the office. Okay. So only those that occur in the factory are factory overheads. So you get the factory rates, 4,500. Is that clear?
Yes, sir.
Factory rates is 4,500. And then we go to what? Depreciation on machinery. That's very important. It's an overhead as well. It takes place in the factory. Depreciation, depreciation on machinery. Can just finish it on machinery. Depreciation on machinery, that is to say, the value that the machines have lost. We are told that the factory machinery is to be depreciated at 20% per annum on cost, which means it's 20% of the cost of the machinery. How much is the cost of machinery?
It's 35,000 US dollars.
Yes. So you get 35,000 times what? Times 20%. So what is the depreciation? What is the 20% of 35,000?
7,000.
It is 7,000. Then to this, we can add the tools, right? The tools. What is the cost on tools? The cost of the tools is 1,000, isn't it?
Yes, sir.
But you also have got the closing value of the tools, isn't it? Have you seen on 30 April 2017, the value of tools now, or the closing value of the tools is what?
Okay, yes.
It's
It's 830.
Yes, so when you bought it, it was 1,000, but the value that has remained now is 830, which means the other value depreciated, right?
Yes, sir.
Write down the depreciation, 1,000 minus 830.
It's 150.
All right. Oh, minus 830.
Sorry, it's 170.
170. Is that clear? Then you can now add up everything, right?
Yes, sir.
You can add up everything. You can add up everything and give us the figure that you find.
Hello, sir. Are you there?
Mm-hmm. Hello? What do you find?
Yes, sir.
What have you found?
To add everything.
Yes, when you add the value of these factor overheads. All right.
It's
So I find
26,770.
26,770. This figure is to be added to the prime cost since we are adding all the costs. So you can add that to the prime cost.
It's 86,020.
86,020. So 86,020, like this. So now, when you get this figure, if you don't have the work in progress, maybe either opening and closing work in progress, you can just end here and report this as the cost of what? Production. Is that clear? You can report this as the cost of production. But when you go back to your question, you find that there is work in progress. You've seen? There has been work in progress, the inventory for work in progress. So
yes, which is 2,820.
Yeah, if you have opening work in progress, you can add it to that figure, okay? Before you subtract. Add the opening work in progress. But since we don't have the opening work in progress here, we just have the closing work in progress. We just subtract the closing work in progress, which is the 2,820 from the same amount. You get what I've said? If you have got opening work in progress, you can add the opening work in progress. You get that's according to the format. You can add to this figure. But since you don't have, you have nothing to add. It's as good as you have added 0. After adding the work in progress, you should do less what? You should do less the closing work in progress. Okay? And how much was the work in progress? The closing one, it was 2,820. So it is 2,800 and what? And 20. Okay. You are
to less. Oh, sorry, subtracting.
You are subtracting the closing work in progress. You add the opening work in progress to the figure. Then after adding to that sum that you're going to find, you can less the closing work in progress. So what is the difference now?
It's 83,200.
83,200. Okay. So 83,200. This is what you're going to report now as the cost of production. Of course, the net cost of production. This one is going to be called your net cost of what? Of production. Is that clear?
Yes, sir.
Yeah, this is just because this question does not mention that there was the profit that needed, profit on the manufacturing that needed to be transferred on profit, okay? But if you have that, according to the format that I gave you, you have to add that, then you have the market value. You can add that allocation of that profit, and the profit on the manufactured goods, and then what you close with, it is not cost of production, no. You call that last figure as the market value. That's what we said last time. So as for now, you can end on the cost of production because that's where the information that we have been given ends from. So basically, this is the whole idea of the manufacturing account, to assess the cost of production. So this is what you're going to put there in the profit and loss account, okay, of the finished goods. When you go on when you're writing that statement, there is that part after opening stock where you write cost of production. Okay, this is the figure that you're going to write on the cost of production. Since you want to write purchases, this business is not involved in the purchasing of the goods and services. No, it just purchases the raw materials. So on that part where you add the purchases, you're not going to add the net purchases. No, you're going to add the cost of production. Right.